Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. Welcome to the weekly Friday wrap-up in this series where I look at Barrons each week to identify high probability trade setups that arise from selected articles. Um, what I'm going to do here is I'm going to show you a winning trade that I share with our subscribers and community members this week. I'll then show you a couple of open positions that came out of some setups that from previous issues of Barrons, which then triggered within the last week or so. And then I'll also show you, most importantly, a number of pending setups where we have the trade set up, and we're now waiting for price to come to us in order to then trigger the trade. And then along the way, I'll lay out the core um, foundation of our trade setups that we share with our subscribers and community members, so that you'll see what's essentially behind the trades. All right, so that's the game plan here. So what we're looking at here is a 1 hour chart of PayPal. There was an article in Barron's that actually talked about the fact that there was insider selling by some of the executives at PayPal, and so that was the thesis of their article, and they were talking about that. So this was the area that I identified for a particular for a trade, and in fact, this was a bearish trade where we ended up buying a put. And of course, I will show you the before picture of this in a second. Okay, but this was the zone that I had identified here. Okay, price had then come up here and then dropped out of here. Okay, but when price arrived here, this is where we bought a put. Okay, so at 63.75, this was the area that we were going to get into the trade. And to be clear, this is just one way of expressing the trade at this region. Okay, one could also express a trade in any number of other ways. So in addition to buying a put, of course, one could also short the stock. One could sell a credit spread in order to take advantage of time decay. And if one also wanted to, let's say, reduce the premium they paid in terms of buying a put, one, of course, could also do a vertical debit spread, and that would reduce the premium, also reduce the effect of time decay, and also make it a gentler trade, because at that point, then you'd be running a lower delta. So those are all ways that one could express a trade from this zone right here. All right. So what is this zone? All right. So let me show you what I was originally looking at. Okay. So here is PayPal. And this is the daily chart of PayPal. And initially, my eye kind of got drawn to this region right here, and then on a secondary basis, it also got drawn to this region. Okay, that's the region that we were just actually looking at in terms of the winning trade. Okay, but this is where my eye first got drawn. Okay, so what's going on here? Okay, price came up. We're looking at the daily chart here. So you notice we have that green candle here, obviously an up candle, and it kind of finished, let's say, in its the upper third of its region. So it's a moderately bullish candle. Okay, so price came up. Then essentially price went sideways. Let me just blow this up a little more. Okay, then went sideways, essentially consolidated, and then notice then price drops out of here suddenly. Okay, there's an exhaustion of buyers. No one is willing to buy anymore in this region over here. Okay, and so this represents an exhaustion of buyers. And then notice after that, there's a gap, a very bearish candle that finishes at the very bottom of its range, and then essentially this march of red candles down here. So this is obviously a whole lot of bearish sentiment here. Okay, so the predicate for this trade is waiting for price to return to this level in order to then take advantage of what we anticipate to be another round of selling here. So why is that? Okay, if we think about the shares that are acquired by buyers, okay, we could think of that as the demand for shares. Okay, so there is a certain level of demand for shares in this region between 66.90 and 68. Okay, that's about $1.10 region here. Okay, okay, we can think of the shares that are offered up by sellers. We could think of that as the supply of shares within this region. Okay, and so in this zone here, supply and demand are in balance, okay? Because essentially shares are getting shuffled back and forth within this relatively narrow $1.10 range. And so that went on for the better part of about 2 days. And then at some point, no one was willing to sell here anymore, okay? And so in here, where there was supply and demand, and there was a balance and equilibrium here, once price drops out of it, okay, there is no longer any supply. Excuse me, there's no longer any demand. There is only supply. Hence, we call this a supply zone. Okay. And because price was in here for only a short amount of time, there is the expectation when price returns to this region, there's going to be another wave of selling. Okay. We almost think of it as there is untapped selling pressure that we're waiting to take advantage of. Okay. And of course that's all predicated on there are certain qualifiers that go into identifying these supply zones here. Okay. It has to do with how price enters the region, how price leaves the region, and also the structure of what's inside the zone. Okay. But once it meets various qualifications, if that occurs and price returns there, then we can express a bearish trade in the ways that I just showed you a couple of minutes ago. Okay, so that was the story with that. Okay, similarly, down below here, I thought that there was the possibility that there might be a supply zone here as well because of the fact that we have this wick here after this gap, and so oftentimes in that situation, if one drops the time frame, oftentimes one will then basically expose another zone that could represent a setup. Okay, and so if we go back to the live chart here, okay, that's the region we were just looking at here. And so when price dropped here, again, we noticed we have that little area of consolidation, and then notice those two very bearish candles. Okay, then there is essentially then a little pause here for about a day or so, and then there's kind of another thump down there. Okay, so this was a supply zone in the 1 hour chart. Okay, we were just looking at the daily chart. Okay, and that was the basis for this trade here. So when price came up here, we then bought a put. Price then dumped for about basically in the space of about the day and a half. And I think by lunchtime the next day, we were already out of the trade. In fact, if you notice, price came down here, and this in fact represented a demand zone. Okay, price basically consolidated, then noticed that a small gap, price popped from there. Now, we did not take the bullish trade out of here. It really wasn't a well-qualified demand zone here, although in retrospect, we can see that, in fact, it was a demand zone. I would have never gone long out of it, but you can see it certainly did work there. Okay, so that's the basis for this PayPal trade. Okay. Let me show you a couple of other setups where we are actually now in a live trade. Okay, so we are in a trade with Ford. Okay, so let me go to the daily chart on that because that's where our trade is. Okay, so right here we have this rally base drop formation. Again, this is that. Again, there's that sudden exhaustion of buyers here. Okay, we had this area of consolidation. No one was willing to sell there anymore. Excuse me, buy there anymore, and then price sank from there. Here's the before picture of what I was actually looking at. Okay, and there was this article in Barrons here on November 24th that buying Ford was a good thing in some of these companies that generate a lot of cash. That was the thesis of this article. So right here was a demand zone, and in fact, this was really actually almost the better setup here. But there was a rally, a base, and a rally there. Notice price rockets out of there, and this is the exact opposite story of what I just told you with respect to the supply zone. Okay, here supply and demand are in balance. Here we have an exhaustion of sellers. What's left in its wake is only demand. And again, when price comes back here, we're anticipating that there is buying pressure that's waiting to essentially be tapped. And so this is where we would express a bullish trade. Okay, so up here we have another one of those supply zones here, and in fact, as you saw on the other chart, that's actually what it ended up happening. So again, when we have a supply zone and a demand zone, we're generally okay in taking each as long as they are well qualified. Obviously there are issues of trend. Once one gets a little more advanced with this stuff, but in a vacuum, a well qualified supply zone or a well qualified demand zone is a good foundation for a trade in either direction. Okay, so that's the story with Ford. So if we now go back to the live chart here, we'll see that price came in here on the 28th. Okay. And so we've now been in this trade for what, about 5 days. Most of us just shorted the stock. It's a $13 stock. It's not a wild mover. And so you really don't get a whole lot of bang for the buck of in terms of using a single long call or long put, unless you're just kind of doing the lottery thing where you're buying it way out of the money and you're just hoping for a big move. But generally, you're not going to get that necessarily with Ford. It's actually a great stock for beginners when they're first learning to trade, and particularly for shorting when that's new to them as well, because it's not a fast mover, but it allows one to kind of get their feet wet. So at any rate, there's that supply zone there. Price came in here. Price dropped out of it. It actually made a quick today. It actually kissed the front line of that, and now it kind of dropped again. You'll see this ladder that's sitting here. That this actually represents our reward versus risk. Okay, here's our entry. Here's our stop out point if things don't go right for us, and we lose control of the trade, which occurs when price goes through this zone here. And so when price, if it continues down the way it is, that would be a 1-to-1 trade here. That would be a 2-to-1 trade. That would be a 3-to-1 trade. Okay, so in the course of how we do this, we're basically looking for, generally trying to get at least 2.5-to-1 on our trades. Obviously, does that occur all the time? Of course not. There are going to be losing trades. There are going to be trades that we get 3 and 4-to-1 on, and then going to be any number of trades where we either break even or we're only getting 1-to-1. It just but that's our aspiration, 2.5-to-1. All right, and of course, the reason for that is you don't want to have a trading system where you have to be right, 70 or 80% of the time, because frankly, you can't be, or at least you can't be and pay for your losers generally. So that's why if you get 2 and 3-to-1 on your winners and you're losing 1 unit on your losers, then you actually have a workable trading system. Okay, so that's Ford. Let me show you another setup here. Here's an open trade on Roblox. And again, this is actually, for whatever reason, this is actually another short trade or another bearish trade. So here is a drop formation in the 1 hour chart. I think just from the two charts that I already showed you, I think this one's pretty obvious here, where price came in here, consolidated, and then notice that march of red candles down there, and particularly the first three of them. They're bigger than the base candles. That signifies that there is greater movement going on there. There's a little pause, and then notice then those two very bearish candles that succeeded after that. Okay, so now when price came back into here today, price came up here. We basically bought a put. We bought the February 20th 95 strike call, excuse me, put. We've actually bought the one that's just a bit out of the money here. More often than not, we actually try to pick the strike price that's behind our zone, so that we're actually buying it a bit in the money. But because of the fact that that would have taken the premium over $10, we bought the one we bought the at the money put, which essentially is the 95, which actually is in reality is what, $1.85 out of the money. Okay, so the reason we did that is that kept the premium under $10. More often than not, when we share things with our subscribers and community members, the premiums tend to be more in the area of 3 to 7. Okay, so this was a bit more than that, so we wanted to keep it below 10. So that's why we ended up using the 95 versus the 100. Okay, so price came in here, dropped out of it nicely, actually in the very beginning, and then over the course of the day, actually kind of recovered a bit. So we're not that different from even here. So we'll see what transpires, obviously, next week. All right. All right, so here's a chart of Monster Beverage. We're looking at the daily chart here. So on November 10th, there was an article in Barron's about consumer staples. They are the kind of the unloved sector of the market at the time, and I believe still are. And that a number of they thought that a number of the stocks might be poised to recover, particularly the ones that are showing relative strength within the sector. And you could see that in the looking at the holdings of the XLP ETF. So that was the thesis of the article. Okay. So at the time, when I was looking at this on November 10th, that was basically around here. Okay. There's November 10th right here. So we were looking at this basically here. And so this is the area that caught my eye. This is a rally-based rally formation. Okay. And so the initial thought that I had was if and when price returned to this, we would get a bounce out of here, and then this is where we would express a bullish trade. Okay, so price came back here, kind of hovered over there, but never quite made it back, and then obviously then shot out of there. So price then basically went all the way up here, but along the way, if you notice, and let me just blow this up just a little more here. But if you notice right here, here is a demand zone that formed. Okay, price came up there. Then we right here there was that move up. Notice then that there's that consolidation there, and then obviously then these two very bullish, larger bullish candles here. So when price returns to this region, this is a demand zone. Again, supply and demand were in balance. Obviously, there was an exhaustion of sellers. No one was willing to sell here anymore. So again, as price returns here, there is untapped buying pressure that we're looking to essentially take advantage of. And at that point, then this is where we would express a bullish trade. Okay, so our entry point for whatever strategy we use, okay, we would get in at 72.55. Okay, if things do not go our way, we get stopped out at 71.55, and then here are the rungs of our reward to risk ladder. That's 1 to 1, that's 2 to 1, that's 3 to 1. Over here, I also throw in here. This is the measured move that goes from here to there. Okay, so that's the full move there. That's about half the move there. That's half the move there. And so one of the ways we try not to get greedy is we want to look to see what was the prior move, and then look to get anywhere from, let's say, half of it. So the half would basically get us to a 2 to 1 trade here. So that's kind of a starter point in helping to manage our expectations about about our trade targets. Okay, so there's that setup. Here is a 1 hour chart of BigBear.ai holdings. In Barron's on the 17th of November, they had an article, the next Palantir. So obviously they're rather bullish about this stock. Again, I don't really care what they think. I'm really again just looking for a quality setup. And right here is the location, what I believe is a quality setup. Okay. So if we look right here, and let me just spread this out a bit. So this is a drop base rally formation. Okay, price drops, consolidates, rockets out of there. Again, we have that exhaustion of sellers. We're waiting for price to return to the region, and this is where we would express a bullish trade. Okay, so at that point, then we throw our lines in there, and pretty much that's our setup. And then here's our risk reward. That's roughly what roughly what our trade would look like. Okay. Before I go on here, though, the usual disclaimer. Precision Trading Labs, we are neither money managers nor financial advisors, and everything I'm doing here is for education and and informational purposes only. So there's BBAI. Here is a 1 hour chart of DELL. Right here we have a rally, a base, and a drop there. Okay, again, here's our basically our supply zone here. Right here we actually have a little odds enhancer here. This is the 50-day simple moving average. To be clear, this is the 50-day moving average. Okay, even though we're looking at a 1 hour chart, this is the 50-day moving average. Okay, so price rallies up there, consolidates. Notice then there's a gap and a thump down. Again, we have an exhaustion of buyers here. So when price returns here, this is where we would express a bearish trade. Okay. Again, here's our entry. There's our stop. There's our risk reward ladder. Okay. So that's the story with that. Here is a 1 hour chart of Bloom Energy. On December 1st, Barron's had an article about, or a piece mentioning that the largest U.S. pension fund actually was a buyer of Bloom Energy and obviously bought a significant number of shares for its portfolio. So that became news. So at any rate, that's why it appeared. So I identified actually two areas of interest in this chart. Okay, right down here we have a drop base rally formation. Okay, again, so this is where if price returned here, this is where we would execute a bullish trade. And then over here, this area right here is a rally base drop. Notice that very, very large angry red candle there that closes at the bottom of its range, and then it kind of thumps down from there. So this is obviously a very sudden exhaustion of buyers here. No one was willing to buy here anymore after that brief consolidation in there. Also, if you look right here, inside of here, and let me just spread this out just a bit, this is actually a bear flag. Okay, so if somebody was playing a breakout or is a breakout trader, this is actually kind of a classic bear flag situation here. In fact, if I turn on the volume here, you'll see there's your flagpole, there is your flag, and then notice obviously then price this drops like a stone out of it. But the thing that makes it a bear flag is if you take a look at right there, there's your characteristic of volume there. Okay, there's your big volume on the flag. There is your diminished volume on the either a sideways or a slight up move, and then when price thumps out of that, notice the revival of that. So that was good for a momentum play, but I would think it's also going to be good for our play when price returns there, and we can express a bearish trade out of that supply zone. All right, so that's the story with. All right, so here's another setup with Robert Half, the business consulting firm. Oh, also, before I talk about the chart here, if you would please subscribe to our channel and turn on alerts from us, you'll know when there are new videos in this series, and then you can keep up with what I'm doing here. So this is a daily chart of Robert Half. I identified two demand zones here. Right here we had a rally-based drop formation, and then right here this is essentially a drop-based drop. Notice again in both cases the exhaustion of buyers, particularly on this lower level here. Notice that each of these candles pretty much close at the bottom of their range, the first three of them, and then this one obviously then takes us down pretty much to the 52-week low. That's what these pink boxes mean, the pink crosses are. So when price returns here, this is the area where we would short. This was the piece that was actually in Barron's on December 1st. The title was Trump Media Stock and 11 More Tax Loss Victims to Avoid until 2026. So what the whole thesis of the article was that these are all these 12 symbols have been beaten to hell over the course of the year, and so they are ripe for tax loss harvesting as people kind of sell their losers in order to offset some of their gains. So they mentioned our friend Trump Media as well as these other these other symbols, including Robert Half. So that was the basis for that. So again, when price returns there, this is where we would express a bearish trade. Okay, so here's our entry, there's our stop, there's our risk reward ladder. And finally, the last setup here, there was a piece in Barrons on December 1st, basically talking about Mexico and Canada stocks are going through the roof. What trade war? In other words, basically companies based in Mexico and Canada have been overall doing quite well, even in the face of Trump's tariffs. So that was the basis for that article. So in the 1 hour chart, basically we had two demand zones that I identified. Here is a drop base rally formation. Okay, again, waiting for price to return here in order to express a bullish trade, and then right here there's a rally base rally there, and then in order to then express a bullish trade down here. Right here again is the risk reward ladder. I'm not necessarily sure how great this is going to be. I'll have to do a little further research on this, but mostly from the perspective of using options. There seems to be only the basically three. They're not technically quarterly options, but the only ones that are available after December are January, March, and June. So I have to see if there is actually the right option for this trade here. So we'll take a look at that. But anyway, right here we have a drop base rally, and again here's our risk reward ladder. So we have about and it's a relatively narrow zone. So in a sense, if one it would be ideal to be able to use options for this, because one is in order to make some money with this, you're going to probably have to put on not a tremendous amount of size, but one contract or 100 shares really doesn't kind of get you there. So, but again, this is a drop-based rally. We're waiting for price to return here, and then this is where we'll express a bullish trade. And then after that, depending on what happens, this is actually really the better zone this is actually a better zone than this one. But we'll see what happens. So at any rate, that's what I got. This is Mitch Firestone with Precision Trading Labs. Again, please subscribe to our channel and turn on the alerts so that you'll know when there are new videos in this series. And I'll see you next time. Take care. Bye-bye.